Yeah, hello friends, welcome to my channel Finance Eco India. So we are just starting just in 2 minutes. Yeah, so let's start. So we will so today's agenda, we will start from the brief market, today's market session. How was it? And then we will go to the today's Q1 financial year 26 results for a lot of companies have came. So we will analyze them like Colgate-Palmolive, Mahanagar Gas, Kajaria Ceramics, Zee Entertainment, Paytm, Zensar Technologies, Dixon Technologies, JSW Infra, and at the last we will discuss about the medical insurance. So how medical insurance should be taken and what are the importance of the medical insurance. Okay, so let's start with the market outlook. Yeah, so today Indian stock market closed flat with Sensex down by a small 0.01% and Nifty 50 down by 0.12%. So the Indian stock market today ended with minimal movement, reflecting a cautious trading session. Sensex closed at 82,186, down by 13.53 points, that is minus 0.01, while the Nifty 50 closed at 25,060, down by 29.80 points, that is roughly 0.12% down. So this flat close suggests a lack of strong directional momentum, possibly due to mixed global and domestic factors. So today's top stocks and sectors are Energy, Eternal and Swiggy were standout gainers, with Eternal rising 10.35, Eternal, that is called formerly Zomato. So yeah, and Zomato was up 10.35 and Swiggy was up by 5.68, likely driven by the positive company news. So yesterday Eternal has given its results. So conversely 360 one arm was a significant drop of 6.32%. Sector wise NBFC and service sector led with gain of 14.40 and 8.60 respectively, while consumer durable and media entertainment sectors declined by 1.25% and 0.62%, indicating varied investor sentiments across industries. So the influencing factor was the market seems to have been influenced by global cues such as rising crude oil prices and uncertainty around the US Fed rate stance, which could fuel inflationary concern for India. Domestically, expectation around corporate earnings like Paytm's anticipated profitability and sector specific news such as Vakrangi's insurance tie-up also played a role. So let's do the detailed analysis now. So Indian stock market as of 4:55 p.m. on Tuesday, July 2020, concluded a trading session characterized by minimal movement, closely nearly flat. The report provided a comprehensive analysis of market performance. So let's see what market indices performance were. Nifty Bank closed at around 56,776, down by 176 points. roughly 0.31%. Nifty IT closed at 36,849, down by 181 points. BSE small cap closed at 55,198, 69, down by 82 points. The flat close, as noted by the Hindu Business Line, indicates a dull trade, with the market lagging significant catalyst for movement. This aligns with the observation that Nifty has entered a crucial demand zone between 25,000 and 24,770, which is expected to act as immediate support, potentially setting the stage for future rallies. So let's talk about today's top gainer and so Nifty bank close as you already seen. So now let's today's top gainer and top losers. So in top gainer, Eternal closed at 299.80, formerly known as Zomato, up by 28.10 points, with a market value of 8,110 crore. So it has given a good result yesterday. So that's why although its profit was down by 80%, but its revenue grew much. So that's why it was up. Swiggy closed at 417, up by 22.40 points, with a market value of 3,407 crore. Ria Magnetite India up by 7.66%. India Cement was up by 5.74%. So top loser was One Arm, closed at Rs 1,144, down by 77 points and minus 6.232%. Bajaj Auto was down by 3.31%. Wipro was down by 2.27%. So Eternal's strong performance also noted in with a gain of 11.32%, suggests positive market sentiment, possibly driven by the quarterly results or sector specific news. So if we see the sector wise analysis, NBFC sector led with a robust 14.40% gain, followed by service at 8.60, indicating strong investor interest in financial and service oriented industries. Conversely, consumer durables saw a decline of 1.25%, and media and entertainment fell by 0.62%. So today there were significant news and events. So let's discuss one by one. So today's Paytm Q1 result was there. So 197 Communication reported a consolidated net profit of rupees 122.5 crore for the quarter ending June 2025, compared to a loss of 838 crore in the previous year. Analysts expect profitability driven by strong revenue growth and robust payment financial service, with the stock up 3% ahead of earnings. So we will discuss its result in detail in coming going forward. So Vakrangi tie up a penny stock under rupees 10 LIC owned and so Vakrangi has tied with Shriram General Insurance to offer insurance product by Vakrangi Kendras, potentially boosting its growth prospects. So when we talk about commodity prices, so gold closed at 99,212, down by 0.12%. Silver closed at 1,14,922, down by 0.1%. Copper closed at 895.70, down by 0.3%. 0.06%. So silver outlook, if we talk about, so Tata Mutual Fund highlighted that silver is undervalued and could outperform gold over the next 2-3 years due to industrial demand and supply constraint with a focus on renewable energy. So Indian rupee settled down 5 paisa at 86.36 against the US dollar amid uncertainty over the US India trade deal ahead of the August 1st deadline. So, like US delegation is also coming to India for the trade discussion. So they would be coming in the August month, first week of the August. So, like still India US trade deal will not happen until first August deadline. So that is also a point of concern. So FI and DI's activity, if we see, as of July 21st, for FIs were not net seller with the outflow of 1,681 crore, while domestic institution DIs were net buyer with an inflow of 3,578, indicating domestic optimism despite global uncertainty. So let's talk about the market context and technical outlook. The market flat close amid dull trade, as reported by the Hindu Business Line, reflects a consolidation phase. Global factors such as rising crude oil prices amid disruption in Iraq and unclear signal regarding the US Fed rate instance have fueled inflationary concern for oil importing countries like India. So domestically, the Nifty has formed 3 consecutive bearish candles from recent high, indicates a loss of upward momentum. However, falling volume suggests that the decline lacks aggressive selling pressure and the overall trend structure remain bullish, with the Nifty in a crucial demand zone between 25,000 and 24,770 expect to act as immediate support. A bullish reversal from this zone could lead to a fresh rally toward 26,000 in the coming weeks. Expert insight and prediction. So Naveen Kulkarni, Axis Security, suggests that the RBI may cut interest rate twice more before entering a prolonged pause, which could support market sentiments. Tata Mutual Fund highlighted silver's potential to outperform gold due to industrial demand and supply constraint. And Religare Broking recommends accumulating Mahindra and Mahindra for short-term gain as it hovers near record high. So if we conclude today's market session, so the Indian stock market today ended with flat close, reflecting cautious trading among mixed global and domestic factors, while sectors like NBFC and service showed resilience. Others like consumer durable and media faced decline. Key stocks like Eternal and Swiggy were notable gainer, while 361 arm was a significant loser. The market is currently in a consolidation phase with the Nifty support zone between 25,000 and 24,770 being critical for future directions. Investors should monitor global oil prices, US Fed policies, and domestic earning for potential trigger in coming days. So now let's move to our next segment, that is the analysis of the results which have came today. So yeah, let's start with the. So in this, today Colgate-Palmolive, Mahanagar Gas, CDSL, Kajaria Ceramics, Zee Entertainment, Paytm, Zensar Technologies, Dixon Technologies, and JSW Infrastructure have given their Q1 financial year 26 results. So we will be decoding their results. So these entities represent a diverse cross-section of Indian economy, spanning fast-moving consumer good, media technology, and critical infrastructure. So let's decode their result one by one. So we will start with the FMCG company Colgate-Palmolive. So Colgate-Palmolive experienced a challenging first quarter of fiscal year 2026. The company reported net sale of 1,421 crore, making a 4.4% year-on-year decline from rupees 1,486 crore in Q1 financial year 26. So yeah, if we go to its results, yeah, so it's had missed on its revenue and profit as well. If you can see the slides, yeah. So profit before tax similarly slipped by 11.7% to rupees 431.95 crore. Operational profitability also uh, faced pressure, with earning before interest, tax, depreciation, and amortization dropping 13.2% to rupees 439 crore, leading a margin contraction to 30.91 from 34% year on year. EPS per share sequentially declined to rupees 11.79 from 13 rupees. So pre-result analysts generally held a hold rating for Colgate-Palmolive, anticipating revenue growth of 7% and profitability growth of 5.5% for the next 12 months. Boomler survey specifically estimated Q1 financial year 26 revenue at rupees uh, 1,479 crore and profit at rupees 346 crore. Again, this expectation, Colgate-Palmolive actual Q1 performance significantly fell short, missing analyst estimate on both revenue and profit. So Colgate-Palmolive's managing director and CEO Pravar Narasimha attributed the Q1 result to persistent headwind from tough operating condition on account of subdued urban demand and elevated competition intensity. The company's performance was also influenced by cycling a high base from the previous year. Looking ahead, management anticipated gradual recovery in the back half of the year. The company remains committed to its long-term strategic priorities, which include category premiumization, brand investment, sustainability, innovation led portfolio expansion, and community focused health initiative. Notably, Colgate-Palmolive introduced new products such as Colgate Kids, Squeeze toothpaste, and Max Fresh mouthwash sachet stick during the quarter. So, one notable aspect of the quarter performance is the company's decision to reduce its total advertising expense by 5.5% year on year. While this measure might have aimed to protect margin in a challenging environment, it presents a potential tension with the stated strategic priority of maintaining healthy brand investment leveraging strong margin. So furthermore, management's explicit mention of subdued urban demand as a key headwind align with broader market observation that the urban consumption segment has been a laggard. Colgate's results therefore serve as an important indicator for the broader FMCG sector, particularly for staple products. Weak urban demand suggests that consumers are either opting for more affordable alternative or extending the usage period of existing products. This macro trend warrants close monitoring across the consumer goods segments at its points to cautious spending environment in urban center. So given the substantial miss on analyst estimate and the acknowledged headwinds, a hold rating continues to be appropriate, consistent with current analyst consensus. Investors should closely monitor for concrete sign of demand recovery and elevate the effectiveness of the company's premiumization and innovation strategies in the incoming quarter. A rebound in revenue coupled with improved cost efficiency will be crucial for stabilizing earning. So let's look at the second company within 1 minute. So Mahanagar Gas delivered a robust performance in Q1 financial year 26, surpassing analyst expectations. The company reported a significant 24.55% year-on-year increase in revenue from operation, reaching 2,282 crore from rupees 1,832 crore in corresponding period last year. Consolidated profit after PAT also saw a healthy 10% year-on increase, climbing to rupees 317 crore from rupees 288 crore. On a sequential basis, net profit demonstrated an even sharper increase of 30% from 243 crore in Q4 25. Operational profitability was strong, with earning before interest, tax, depreciation and amortization, that is called EBITDA, rising over 24% to rupees 485 crore, and the EBITDA margin expanding to 24% from 20% in Q1 financial year 25. So prior to the result, analyst has a more conservative outlook, expecting Mahanagar Gas Q1 financial revenue to grow by 14% and anticipating a 4% decline in net profit. Bloomberg survey estimated revenue at 1,590 crore and profit at 256 crore. So Mahanagar Gas actual performance significantly exceed this projection on both the revenue and profit front. So this company has outperformed the performance, beat the estimate, while specific direct management commentary regarding was not detailed in provision information. So yes, and now we will talk about the strong operational outperformance, particularly the significant expansion of EBITDA margin is noteworthy. This occurred despite analyst expectation for a profit decline and margin contraction. This indicates robust operational efficiency and potentially favorable gas pricing dynamics or a strong volume growth in quarter, which analysts may have underestimated the ability to expand margin in the current economic climate in a significant positive. So as city gas distribution company, Mahanagar Gas operates within an essential service sectors. Its strong financial performance contrasts with the subdued urban demand observed in more discretionary and FMCG sector, such as Colgate-Palmolive. This highlights the defensive characteristic of the utility sector. In periods of economic uncertainty, companies providing essential service often demonstrate greater resilience and more stable demand. So this was a necessary utility sector. So in spite of the dip in the FMCG sector, it is having good demand because this is necessary thing. People cannot cook their food without the gas actually. So given the substantial beat on both revenue and profit estimates, coupled with robust margin expansion, Mahanagar Gas presents a positive outlook. So analyst consensus already placed the stock at a moderate buy, with an average price target of rupees 1,559. Investor may consider an accumulate strategy on price dips as the company continues to demonstrate strong operational performance within a resilient sector. So for CDSL, its result is going to come on 28th July. So we will be going to Kajaria Ceramics. So we will discuss about its performance and outlook. So Kajaria Ceramics reported a mix but ultimately positive Q1 financial year 26 with a notable increase in profitability despite a sequential dip in revenue. The consolidated net profit for the quarter stood at 110 crore, marking a significant 19% increase year-on-year from 92 crore. This also represents a substantial 155% rise quarter-on-quarter from 43 crore in Q4 financial year 25. Conversely, revenue declined by 9.7% Q-on-Q crore with total income also dropping 9.5% Q-on-Q to rupees 1,115 crore. A key factor contributing to the profit surge was a 14% Q-on-Q decrease in total expense, which led to rupees 964 crore profit. So, pre-result analyst estimates for Kajaria Ceramics were around rupees 5.7 crore. EPS were around rupees 5.7 and sales were projected at around 11.57 billion, and Kajaria Ceramics reported profit of 110 crore, translate to approximately 6.92 EPS, which exceed the analyst EPS consensus of 5.7 rupees 5.7. However, the revenue of 1,102 crore appears to have fallen short of the sale forecast. Despite a historical trend of missing EPS and sales estimate, the quarter's profit beat is a positive surprise. Now let's talk about what management has to say. Management indicates the market remains still muted, but Kajaria aims to perform much better than the industry. The company anticipates a revival in export, projecting a 25% year-on-year growth in financial year 26 to reach 200 billion. Plans also include ramping up the Nepal plant utilization to 70 to 80% in financial year 26. To enhance competitiveness, the company has initiated measures to optimize sale and marketing resource and is exploring other cost optimization strategies. A significant strategy decision was the board's approval to discontinue the plywood business, citing a lack of strategic fit and continued loss. Management also expressed optimism about the real estate market, expecting conditions to be much better, which would benefit the company. The most striking aspect of the quarter performance is the substantial result in the net profit despite a sequential decline in revenue. This is directly attributable to a significant decrease in total expense. This indicates that Kajaria Ceramics successfully implemented aggressive cost optimization measures, which compensated for the soft demand environment. This strong focus on margin preservation and operational efficiency is a positive signal for investors, demonstrating management's ability to control cost effectively in a challenging market. So, decision to discontinue the plywood business due to its lack of strategic fit and ongoing loss is a crucial long-term positive. By shedding it's a good decision by Kajaria to discontinue its plywood business. So it's going to like venture such as bathware and adhesives, which showed growth in Q4 financial year 25. This strategic rationalization is expected to improve overall profitability and capital efficiency, aligning with management's goal to outperform the industry. So Kajaria Ceramics Q1 performance, particularly the strong profit growth driven by effective cost control, is encouraging despite the revenue softness. The long-term outlook appears favorable due to strategic adjustment and anticipatory recovery in the real estate sector. Analyst consensus rates the stock as a moderate buy with an average price target of rupees 1000. Investor may consider a buy on dip strategy, closely monitoring the revival in urban demand and export markets. So now let's move to other company, Zee Entertainment Enterprises. So let's Zee Entertainment Enterprises reported a mixed financial performance in Q1 financial year 26. So consolidated net profit saw a 21% year-on-year increase, reaching 143 crore from rupees 118 crore in the prior year. However, this profit declined by 24% quarter-on-quarter from rupees 188 crore in Q4 financial year 25. Total income for the quarter declined by 13% year-on-year. Revenue from operation also fell significantly, dropping 14% year-on-year to rupees 1,825 crore and 16% Q-on-Q. So the breakdown of the segmental revenue reveals the driver of this decline. Advertisement revenue stood at rupees 758 crore, down from rupees 911 crore year-on-year and 837 crore Q-on-Q. Subscription revenue was relatively stable at 982 crore, a slight decrease from 987 crore year-on-year and rupees 986 crore Q-on-Q. The most pronounced impact came from other sales and services, where revenue significantly dropped to rupees 85 crore from rupees 232 crore year-on-year and rupees 360 crore Q-on-Q. So pre-results, Prabhu Das Leeladhar expected a net profit of rupees 140 crore and projected net sale to rise 94.8% year-on-year, though this revenue estimates appear to be a significant underestimate compared to actuals. Another forecast anticipated 10% year-on-year revenue growth and flat net profit year-on-year. Zee's reported net profit of rupees 143.7 crore exceeds Prabhu Das Leeladhar's estimate. However, the actual revenue of 1,825 crore, which in line with Bloomberg's estimate, significantly missed Prabhu Das Leeladhar's much lower sales projection. So let's talk about what management has to say. Management attributed the overall revenue decline primarily to the sharp decrease in earning from the other sales and service segments. The company is pivoting from a growth at any cost strategy to a more focused and disciplined approach, with aim to cut costs, improve content monetization, and boost user engagement for its digital platform. G5 to achieve break-even. For financial year 26, G targets improvements its EBITDA margin to 18 to 20% and increase its TV viewership share to 17.5%. Management is optimistic about an 8 to 10% increase in advertisement revenue in financial year 26, driven by re-entry into free-to-air channel, new genres, and a focus on regional content. So this significant decline in total revenue, particularly the sharp drop in other sales and service revenue, is a critical observation. This segment underperformance disproportionately impacted overall revenue. So this suggests a structural challenge with G's revenue stream potentially indicating a slowdown in content syndication, film production, or other non-core media activities. While subscription revenue remains relatively stable, the decline in advertisement revenue also points to broader pressure on core business top line. This situation necessitates a strategic evaluation of its revenue mix beyond just cost cutting. So despite the profit beat, G's share fell 6% following the earnings announcement. This negative market reaction occurred after a recent event where a fundraising proposal of rupees 2,237 crore from promoter group entities was rejected by shareholder. This indicates that the investor sentiment is not solely driven by quarterly financial numbers but also by broader corporate governance and funding clarity. The rejecting fundraising even with management stated intention to utilize cash reserve wisely introduces uncertainty regarding future capital allocation and strategic flexibility. For investors, this serves as a signal to exercise caution and closely monitor how the company plans to fund its future growth and manage its balance sheet without direct promoter financial support. So G's Q1 result present a mixed picture. A profit beat overshadowed by a significant revenue decline and a negative stock reaction, further complicated by recent fundraising issue. Analyst consensus stands at hold. Investors should adopt a cautious hold approach. So now let's talk about the Paytm. 197 communication, its revenue and all the market outlook and what the its management has to say, and did it beat the estimates or not. So 197 communication achieved a significant milestone in Q1 financial year 26, swinging to a consolidated net profit of rupees 122 crore. This represents a substantial turnaround from a net loss of rupees 839 crore a year ago period and a loss of rupees 540 crore in Q4 financial year 25, making the company's first ever profitable quarter. So it's good that it is making profit. Revenue from operation also demonstrated strong growth, rising 28% year on year to rupees 1970 crore from 1502 crore. On a quarter on quarter basis, revenue saw a marginal increase of 0.3% from rupees 1911 crore. So segmental performance was robust. Net payment revenue increased to 88% year on year to rupees 529 crore, while revenue from the distribution of financial services surged 100% year on year to rupees 561 crore, primarily driven by growth in merchant loans. Paytm maintained its leadership in merchant payment, boasting 1.30 crore merchant device subscriptions. The company also reported a healthy cash balance of 12,872 crore. An exceptional item in the quarter was an accelerated charge of rupees 492 crore resulting from the cancellation of 21 million ESOP granted to the MD and CEO, a move undertaken to address SEBI concern. So pre-result analysts have varied expectation for Paytm profitability. Bloomberg projected a significant narrowing of adjusted net loss to rupees 126 crore, while revenue expected to rise 31% year on year. JM Financial anticipated a profit tax exceeding 18.9 crore, while Motilal Oswal expected a modest profit of 2 crore. Paytm reported net profit of rupees 122.5 crore, substantially exceed all these analyst expectations, which has either forecast a narrower loss or much smaller profit. The revenue of rupees 1970 crore was largely in line with or slightly below the higher end of the analyst revenue estimates. So how this happened, let's discuss. So Paytm's swing to profitability is a major achievement, particularly following a period marked by regulatory challenges and substantial losses. The exceptional charge from ESOP cancellation, while impacting reported profit in previous quarter, signal a cleanup of the balance sheet, settling a clear path forward. This indicates that Paytm has successfully navigated its post regulatory transition phase by focusing on core revenue drivers such as merchant payment and financial service distribution. The strong year-on-year growth in this segment, coupled with disciplined cost management, points to improved operational efficiency and a more sustainable business model. For investors, this suggests a potential inflection point for the company, shifting toward a model centered on profitable growth rather than solely growth at all cost. Yeah, so it's good that company is now focusing on the efficiency and margin. So it's good. So the company's revenue growth is notably driven by high quality subscription merchants and merchant loan, which offer high take rates compared to personal loan. This strategy focuses on higher margin revenue streams with its payment and financial services vertices is crucial for sustaining profitability. Paytm established leadership in merchant payment and its expansion in financial service provide a robust foundation for future growth. Furthermore, the renewed NPCI approval strengthens its position in the UPI ecosystem, which is vital for its long-term growth and monetization effort. So now what investors should do? So Paytm's strong swing to profitability, significantly exceeding analyst estimates, indicates a positive trajectory following its regulatory challenges. The stock has already experienced a notable recovery. Investors may consider a buy rating with a focus on the continued sustainability of its margin territory. So further UPI monetization and deepening of its lending partnerships. Okay, so let's move to Zensar Technologies. So Zensar Technologies reported a solid Q1 financial year 26, demonstrating an increase in net profit. The consolidated net profit for the quarter reached rupees 182 crore, an improvement from rupees 157 crore in the corresponding quarter of previous year. While the official Q1 financial year 26 revenue figure was not explicitly detailed in the provisioned information, analysts estimate for the quarter range between 1,374 crore SDFC Sky and 1,375 crore Bloomberg. So pre-result analyst has projected Zensar Technology revenue growth at 1.1% quarter-on-quarter and 6.7% year-on-year, with an estimated net profit of around 175 crore. So for all these surveys, Zensar Technologies reported net profit of 182 crore, exceed these analyst expectations, assuming revenue was broadly in line with expectation, and this performance indicate strong profitability. So it has beat both the revenue as well as profit estimates. So direct management commentary for Zensar Technologies was not available, but however the broader IT sector commentary from the quarter highlighted prevailing macroeconomic uncertainties and cautious client spending, which impacted R&D expenditure and decision-making cycle across geographies. Even major IT players like TCS reported muted revenue growth during this period. And Zensar's ability to surpass profit estimate despite the industry-wide headwinds suggests robust internal cost management, efficiency, project delivery, or a favorable client mix. This performance indicates a degree of resilience and potentially superior execution compared to some of its peers, positioning it an attractive prospect within the IT sector landscape. So now let's go to the another company, Dixon Technologies. So Dixon Technologies delivered an exceptional performance in Q1 financial year 26, significantly surpassing analyst expectation. So the company reported a consolidated net profit that soared by 100% year on year to rupees 280 crore, up from rupees 139 crore in the corresponding quarter last year. Revenue from operation also saw a remarkable surge of 95% year-on-year, reaching rupees 12,835 crore from 6,578 crore. So operational profitability also improved, with earning before interest EBITDA increasing by 89% to 484 crore, and the profit PAT margin slightly improved to 2.2% from 2.1% year on year. However, the company's net debt increased to 214 crore at the end of June 2025, compared with 62 crore as of March 25. So Boomler's survey of analyst estimates Dixon Technologies net profit for Q1 financial year 26 at 221 crore and revenue from operation at 12,150 crore. So Dixon Technologies' actual performance significantly exceed these analyst estimate on both net profit and revenue. So company's strong performance is attributed to strategic deals and anticipated benefits from the electronics component manufacturing scheme. Dixon recently signed a binding term sheet to acquire a 51% stake in the Q-Tech India, a strategic move aimed at manufacturing camera and fingerprint modules for mobile handset, IoT systems, and automotive application. This acquisition is expected to further strengthen its position in the smartphone and broader electronics manufacturing segments. Management speaker include Vice Chairman and Managing Director Atul Lal and Chief Financial Officer Saurav Gupta were scheduled for an earning call to discuss Q1 financial year 26 results. So near doubling of both revenue 95% year on year and profit 100% year on year is an exceptional performance, far exceeding analyst expectation. This indicates aggressive market share gain and successful scaling of operations. The mobile and EMS division, which previously demonstrated a 221% year-on-year growth in 9 months financial year 25, is a key driver of this expansion. Dixon is clearly benefiting from the Make in India initiative and the Production Link Incentive PLI schemes in electronic manufacturing. The acquisition of a stake in Q-Tech India reinforces its backward integration strategy and expansion into higher value components, which could further boost margin and revenue in the future. The increase in net debt is likely a consequence of this rapid expansion and strategic investment, which appear justified by the strong growth trajectory. So the company's focus in backward integration, automation, and increasing high margin component capacity position it for industry leading margin and structurally higher long term profitability. Its expansion in mobile manufacturing and global partnerships are also critical elements of its strategy. This suggests that Dixon is not merely benefiting from favorable market condition but is actively shaping its future through strategic investment in manufacturing capabilities and product diversification. This indicates a strong long-term growth story, moving beyond simple assembly to more complex component manufacturing, supported by favorable government policies and strategic foresight. So, what investors should do now? So, Dixon Technologies delivered an outstanding Q1, significantly beating estimate across all key metrics. The strategic initiative further reinforces strong growth trajectory. Analyst consensus is generally buy, despite a slight dip in stock price following the earning announcement. The underlying fundamental remains robust. Investor may consider a strong buy rating. Recognize the increased depth as an investor for future growth. So now let's come to our last company, JSW Infrastructure. So, JSW Infrastructure scheduled to announce its financial earnings on 22 July. As of the time of reporting, profit were not explicitly available in the providing information. However, company's performance in the preceding quarter set high expectation of for Q1 financial year 26. So, JWS Infrastructure reported record profitability in Q4. So today its result has to be announced. So still we are waiting on it. So we can discuss this JSW Infra for tomorrow. So now now let's move to our next segment. So now let's talk about the mutual insurance, medical insurance. So how medical insurance we should buy and why we should buy. Before that, let's see a short video on this, and then we will discuss more on it. Meet Rajiv, a 35-year-old engineer, living a happy life with his wife and daughter. One bike accident, 6 days in ICU, and his entire 12 lakh life saving disappeared. Why? Because Rajiv thought health insurance was just another expense. What if I told you it's the one thing that could save your family from a lifetime of financial pain? It was a sunny day. Rajiv took his bike out like always. At a signal, a speeding SUV hit him. Without seconds, he was unconscious, rushed to the hospital, diagnosed with fractured ribs, liver injury, internal bleeding. He survived, but his hospital bill, rupees 12 lakh, no health insurance. He had to break his fixed deposit, stop SIPs, take a loan for his daughter's school fees, a lifetime of saving wiped out in 6 days. Most people say health insurance is expensive, but is it? A 10 lakh policy for a 30-year-old couple cost 8,000 a year. That's just 22 rupees a day, less than your evening chai and samosa. Meanwhile, medical inflation in India is rising at 10% every year. A 5 lakh surgery today could cost 15 lakh in 10 years. Can your saving keep up, or do you want to leave your family's future to chance? Or you want to give them a very good future? So it's in your hand to take insurance or not. Let's bust the 5 most dangerous myths about health insurance that are silently draining your future wealth. You may have heard them, believed them, or even said them. But after this, you will never look at health insurance the same way again. Myth number 1. I am healthy, I don't need it. That's like saying I never had a fire, so I don't need fire insurance. Emergencies never send invites. Accidents, sudden illness, surgeries, they can happen to anyone anytime. The time to buy health insurance is when you don't need it, not when it's too late. One hospitalization can wipe out your savings. Why take the risk? Myth number 2. My company give insurance. Sure, employer health insurance is great, but have you checked the fine print? Does it cover your parents, spouse, children? Most don't. And what happens when you switch job or retire? You will lose coverage, and by then, personal insurance may become too expensive or even unavailable due to age or health issues. You may have a backup personal health policy. So sometime it also happens that there is firing nowadays. There is very less job security. So you lost your job. So at the moment your job is gone, your health insurance will be gone. The time when you need most the health health insurance, it would not be there. So it's better to have your personal health insurance. Myth number 3, it's complicated. It used to be, but today platforms like Policy Bazaar, Ditto, and even government portals help you compare and choose in minutes. Just check 3 things: sum insured, hospital networks, and waiting period. We will show you how in the next section. Myth number 4, insurance never pays. This one hurts the most. People say this when claims get rejected, usually due to exclusion they don't read. Every policy has terms: pre-existing condition, wait time, room rent limits, non-payable items. So understand them or let a licensed advisor explain. When you choose wisely, insurance does pay. So you have to choose the insurance wisely and also read all the terms and see what are covered and what things are not covered. So choose the best insurance that covers all things. So myth number 5 is I will buy it later. Later might be too late. Even years you wait, your premium increases, and worse, your risk profile changes. Diabetes, hypertension, or even a bad blood report can lead to higher premium or outright rejection. So the best time to get health insurance yesterday, the next best time today. Now let's discuss the steps to choose the right medical insurance. Let's simply choose the right health insurance. No jargon, no just clarity. Step 1. Start with basic, individual plus family floater. If you are single, get an individual plan. But if you have a family, go for a family floater. One premium covers all. It's cost effective and flexible. Step 2. Minimum 10 lakh coverage. With rising medical cost, even one hospital visit can cost lakhs. Aim for at least 10 lakh coverage. This is the sweet spot for urban Indians. If budget is tight, start with 5 lakh and top it up later. Stage 3. Large cashless hospital networks. Always choose an insurer with a wide cashless hospital network. This means you don't need to pay upfront. Just swipe your card and get treated. More hospitals is equal to more convenience in emergencies. Step 4. No claim bonus. This is a hidden gem. For every year you don't claim, your coverage increases without extra premium. A 10 lakh plan can become 15 to 20 lakh in 4 to 5 years. Huge benefit for staying healthy. So this feature I have used the most. So I have taken the premium of 10 lakhs, coverage of 10 lakh, and now my coverage is around 15 lakhs. So it's the very good feature. If you don't take the claim, so you will get the no claim bonus. So it's add up accumulating, and this is the best thing. So when the time when you need more in your older age, so there you will have large cover in the small premium. So step number 5, understand waiting periods and exclusion. Many people get shocked at claim time because they don't read this. Even policy has waiting period 2 to 3 years for pre-existing illness, and some diseases or treatment are excluded. Know them in advance. So clearly read all the documents, or please consult your advisor so that they will give you the best plan which you know what all diseases are covered and which all are not covered. So there are some also add-ons which you can take if you want those diseases to be covered. So yeah, wisely choose them. Step 6. Use trusted platforms like Policy Bazaar or Ditto. These platforms have compare plans side by side, give unbiased guidance, and even assist during claims. Instead of running around, get clarity and peace of mind. So final tip would be, don't chase the cheapest, buy the most value packed policy, because when illness strikes, the right coverage saves your health and your wealth. Rajiv now shares his story to others. He says, if I had spent rupees 600 per month earlier, I would still have my life saving today. You work hard, you save hard, but one emergency can erase it all. Health insurance isn't an expense, it's a shield. Want to know more about how India's top CEOs protect their families with insurance? Click on the next video where I will break down their secret strategy. So if you like this advice, financial advice, please subscribe to my channel Finance Eco India for more such financial advice that will help you in planning your money and save your money. Thank you. Bye bye. So friends, now let's see. As we have seen the video, now let's see how to opt for the how to buy the mutual best insurance. So for buying the medical insurance, I will give just a demo on how to search for the medical insurance, what to compare and everything. And so this is I will be using Policy Bazaar for the demo. So yeah, let's start the demo. If you have any questions and queries, please feel free to write in the comment box. I will be happy to answer that. So yeah, so within 1 or 2 minutes I would be starting the demo. So what we will do, we have to buy a medical insurance. So we will go to this health insurance thing. So this is the Policy Bazaar website. If you will type www.policybazaar in the Google, then you will get this. So if you click on view all the product, so personal insurance, in this term life insurance, this is health insurance. We have to buy the health insurance, so we will click on the health insurance. So here when you will click, it will ask for the details. So like firstly it will ask for like you want the medical insurance for self or for all the persons you want. Like for if you want self, you will do self. Firstly you will like check your gender. Like if you are male, you will select the male. Then you want for self, you will check this. You want also for wife, so you will select this one. You want for son, so son, if you have two sons, then you will just click 2. And if you have one daughter, so you can click 1, and 2 daughters, then 2. And if you also want policy for your parents, then you can tick on your father and mother also. So right now we will say check the insurance for self, wife, and 2 son and 1 daughter. So there is also option of like grandfather, grandmother, father-in-law, mother-in-law. To these also you can choose in your same policy. So now I have only selected for self, wife, son and daughter, and then we will continue it. So after continue, select your age covered member. So now you have to enter your age. Suppose you are 40, your wife is of you enter 40 years, your wife age you enter 35 or 30 or 35 something. Your first age son's age, your age you can do 40 or 37, 32. Son's second son age is like 4 years, daughter age is around 2 years or something. Then you can continue. So here you have to select the which city. So for city, either you can select whichever city you are in. If you select the like major cities, then it will cater, like if you are in NCR or near to Delhi, then you can select Delhi. If you are in a small town also, then you can select any of the nearest big metro city. So also you have to check the policy which is serving a large number of like which has large number of hospital chain. So suppose I have selected Delhi. So after selecting that, you have to give your full name and your mobile number. So like if I give 9617, so then we will continue. So here medical history, if you have any like issue, pre-existing issue, then you should definitely check this here. Otherwise your claims could be rejected. So if you have any of these pre-existing diseases, then you should definitely check that. Like if you have diabetes or blood pressure, then you should, if you have any heart related disease or something heart complication, then you should definitely select these check-ins. Otherwise if you don't select all these, then at the time of claim there would be problem. So and if you don't have any of these complexities, then you just select none of this, and your office provide with health insurance. If you have official your office health insurance also, then you just click yes. So what is the cover amount your office uh, insurance has? So cover amount also you can mention, or you don't remember that also you can do. So then now you will click on the view plans. So it will fetch all the plans, all the medical insurance available. So now filters we have to, so through edit you can also, like whatever details you have filled, you can change them also. So your all these details you want to include them or exclude some of the members, that also you can do. So now through filter, like if you want cover of like 5 to 9 lakhs or below 5 lakh or up to 5 lakhs, or you want cover more than 10 lakhs to 24 lakhs, then you can just click on that, and then that filter like 5 to 9 years. Or you want to short by relevance, premium low to high, or you cashless uh, hospital network, if it has some company has more cashless hospital network, then you want to select one, then you select that and then apply. So new launches means new health insurance which are launched, you can select that one also, you can go with that. So there is one no room rent limit, this filter also you can check. For doctor consultation and pharmacy also included, that you want that insurance, then you can select that one also. So there are multiple like if you want any particular insurer, like if you want Star Health or Niva Bupa or anything, you want to only want to see the insurance available for this, like a Star Health insurance, then you can use that filter only also. Some of the like maternity cover also you want, so you can select that also. So if you click on this, so here you can see all the filters available, like room rent type, policy benefits, what is in, like in policy benefits you see pre-hospitalization covered, post-hospitalization covered, no claim bonus, daycare treatment, restoration benefit, free health checkup, doctor consultation and pharmacy. So all those things you can uh, check, apply in the filter if you want to select that. So these are the filters. You can just apply these filters. Cover, so how much amount of cover you want, less than 10 lakhs or more than 10 lakhs, all those things you can select. Room rent type, no room rent limit or single private room, shared room, all those things also you can. Policy benefits, I have already. Premium per month, if you want, so that also you can select what premium you want. Portability, like you just like you, if you have existing plans, and you want to go to the other service provider, then also you can check for port existing plan or buy new plan. Maternity cover, like some of the uh, policies don't have maternity cover, that you can check. And here existing disease waiting period, if you want insurance you don't want to wait for the existing disease cover, so that also you can check for 1 year, 2 year or 3 year. Policy periods, like this policy is available for 1 year, 2 year, 3 year, or up to 4 years and 5 years also period. Insurer, like all the insurance whatever present, that also maternity cover you want, that also. Like if you have done all the your child planning, you don't have planning for new child, so then like it's not covered in all the medical insurances, so you can opt out from this. So now you can apply the filters and see the results. So you can also sort it by Yash premium, low to high. You can check. Medicare, Tata Medicare AIG is having 10 lakhs premium by. So by this way you can select the whatever ideal for your condition, whatever what all facilities you want. So you want top up and things and all those things also, so you can do. You can also talk to the expert, they will call back you on your number if you want more details. So this way you can buy the pre health insurance select. And you can also compare your, suppose uh, I have had to compare, you are comparing this plan, Star Health plan and Tata AIG plan. I want to compare so three plan, and if you select Neva Bupa also, like compare now, you can also compare these the three plans. So room rent limit, single mid year number addition, if you have newborn that will be addition. Renewable bonus, uh, so renewable bonus is suppose you don't take the claim in the previous year, then you will get the renewable bonus for that. Free health checkup is also in some of the policies available, like every year you get a certain amount of free health checkup. So detailed comparison, or if you want to customize your plan also, then you can do. So this way, like copay, like copay is like if you are taking any insurance and you something in some insurance it is you don't have to pay anything, and in the sum then 10% of amount you have to pay whatever insurance you take. So that is copay only. Pre-hospitalization cover, so how many days, and pre and post hospitalization cover, daycare treatment, what all care treatment are covered, that you can see. Hospitalization in home, these ambulance charges, all these things also you can see. Value added, like add-ons are also there that you can check. So all those things you can do and compare and take the plan according to your waiting period for existing disease also. You can check for some of the policies it's covered from the diseases are covered from the day one, and from some policies you can just see and add in your plan and compare. So this was all about buying a health insurance and why it is important. So like diseases don't or emergencies don't come by saying us knocking our door, so it can come anywhere, so it's better we are prepared. So in my case only, like I have taken a policy 3 year back, and I also have office policy also. So I haven't taken any claim. So of my 5 lakh I got the no claim bonus, and right now when I am renewing my policy after 3 years, I am getting a no claim bonus of 3 lakhs. So in the amount of with the premium of 5 lakhs I am getting a cover of 8 lakhs. So that's the best part of it. So one more main thing I want to focus on it is that if you don't take your personal medical insurance when you are young or your age is less, the premium is less, and when your age is increased, so that premium also increases. So like when you uh, like for official health insurance you have, but suppose you retire or something, so most of the cases you need health insurance at the old age only, when you are aged more. So at that time your official office one health insurance will not be there. So better, and if you want to buy at that time, then health insurance will be very costly. If you buy the health insurance right now, so it would be like cheaper also. And also like this is the strategy which you can follow. You take the claim from your official, if any claim comes, you take the claim from your official office policy only. And you every year when you renew your plan, personal health insurance plan, you will get the no claim bonus, and that no claim bonus will accumulate amount. So in very less premium you will enjoy a amount of uh, large amount of coverage. So 10 or 5 lakhs premium, giving premium for 5 lakhs, you would be in a long term you will be getting a benefit of 20 lakh coverage. And if you see the health inflation also in India, a surgery which is causing costing around 10 around 4 to 5 lakhs right now, after 3 to 4 years or 5 years it will cost more. It will cost around 30, 10 to 20 lakhs. So better you equip yourself with the health insurance and don't wait for any mishap to occur. So you take the health insurance better. So do you have any question or comments? Please comment. I am happy to answer those your comments and queries. So guys, please comment if you want any question or more question. I will wait for 5 to 10 minutes and then I will wrap up the session. So if you have any questions, please ask in the chat. I am more than happy to help you guys in that. to buy your health insurance. It is very important nowadays. So like if you will not buy the health insurance, if some emergency come, then whatever saving you have, that will be wiped out. And nowadays if you go in a hospital for normal checkup also, like the its cost is very high. Like doctor fees minimum in any hospital is around 1500 to 2000 minimum. And if you go to hospital, the doctor will write you the prescription and all those tests, give you the tests also. Those are also very costly. So better to take health insurance, so that cost will all those cost it will cover. So yeah, health insurance uh, better, or it would be better if you buy the health insurance early, so it will cost less. And if you delay the decision of taking the health insurance, it will cost you more also, because its premium increases by the age. And when your age become more, then you have many lifestyle diseases like diabetes and all those things happens. So better. And if you will take the health insurance, all those diseases will be not be covered from day one. So some of the it will be covered from 2 or 3 years later. So yeah, best you go and take the health insurance early. Yeah guys, if you have questions, please feel free to ask in the comment. Yeah, you all guys can also talk about the ask the question about any topics, mutual fund, stocks, anything you want, or you want me to make any video on anything. uh, it would be I would be happy to make the video on all those topics. Please do comment me. So let's talk about the, like this week lots of companies are giving the dividend. So we'll talk about the dividend stock. So HDFC Bank, India's largest private bank, reported a Q1 financial year 26 profit of 12%. It declared a 1:1 bonus issue. It is giving the first time in the history HDFC Bank is giving a 1:1 bonus and an interim dividend of 5 rupees. So record date for dividend is 25 July. So you have to buy before 24 July to be eligible for the dividend. And bonus date, record date is 27th August. So another company is GTB Engineering Limited. So it produce industrial products firm. It announced 1:5 stock split and 2:1 bonus to reward shareholder and improve credibility. So its record date is July 28 for both action, stock split as well as bonus. So Pidilite Industries have also declared a bonus of dividend of rupees 20 per share. So final this is the final dividend for financial year 25. Its record date is July 23. So tomorrow is its record date. So I think if you have bought today, then you would be eligible, have been eligible for the dividend. So Aditya Birla Sun Life AMC, that has also announced a dividend of rupees 24 rupees per share. Its record date is 23rd July. Havels India, so yesterday it has declared its result. Its results were mixed, and it has it works in the electrification and appliances measure. So it works in the wire and cable segment as well as EPMG. So it has EPG, fast moving electrical goods segments. Also it has declared a 6 rupees final dividend. Its ex dividend date is was 25 June, no, 25 July. Yeah, Hero Motocorp, two-wheeler leader approves. It has a Hero Motocorp, a good name in the two-wheeler industry. So it has announced a dividend of 65 rupees final dividends for financial year 25. Its record date is 24 July. Sri Cement has also record a final dividend of 60 rupees and its record date was July 21st. So it's over. MNC India announced rupees 160 final dividend plus 375 special dividend. Its record date is July 25, 2025. Mahindra Logistic has also declared a dividend of 2.50 final dividend. So these are where the dividends coming within the this week. So if any questions or any comments you want to do, please feel free to comment. So guys, if you have comment, please comment for any question. So I am wrapping up today's session. Okay guys, thank you for your support and help. Thank you everyone. Bye bye.